According to the American Association of Individual Investors' latest survey, optimism around the markets is trending lower, but so is pessimism. Bullishness among individual investors fell 5.9 percentage points to 34.1%, which is below the historical average of 37.5%. There's more where that came from. Happy days are not yet here again, according to Oppenheimer Asset Management here. Take a look at this. Oppenheimer reminding investors to know what they own, why they own it, and have reasonable expectations. Joining us now, we've got John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. John, great to speak with you as always. All right, you're really just saying, and not necessarily pouring cold water on things, but saying, hey, everybody, relax here. Just take stock of what you already have, why you got it. So walk us into what you're reminding customers right now, or your clients right now.
Great. Well, what we're reminding them, first of all, thanks for having me on the show. Great to be on Yahoo Finance. First thing is where we are right now, we have still seen remarkable gains from the rally from last October through today, if you look at how the market has performed. So what we're getting here is a little bit better than a haircut. It's been a corrective mode in the markets, but a lot of that we think is calling upon seasonality for one thing, increased geopolitical risk, and what remains for the equity market, particularly some, we'd have to say, denial about the fact that the Fed is adamant about the fact that it is going to be vigilant against inflation, wants to put inflation in check. But at the same time, the actions of the Fed since last March, when it started this rate hike cycle, to us show remarkable sensitivity to the effects of their mandate as practiced on the economy. As the consumer remains relatively strong, jobs remain relatively strong, the economy looks like it's going to print a nice GDP number here. We've got to say, things are getting better even as they remain proceeding through a gauntlet near term.
John, is that though going to be enough? Is that going to be enough to kind of shrug off the massive rise that we've seen in yields if the economy is able to remain resilient like we've seen, and if earnings do come in better than expected, that's enough there to get the S&P to that 4,900 target?
I think that's it. Yeah, Shauna, I think that's it. It really depends upon the quality of the earnings season, the Q3 earnings season, as it progresses. Right now, when I last looked at it, it's seven sectors still printing positive earnings growth, with four negative earnings growth. They're similar to the second quarter reporting season. The surprises are outpacing expectations. And what it shows is resilience in corporate earnings and revenue growth to some extent. We're not looking for robust here. The main thing is, as we move towards the end of a Fed funds hike cycle, we have to be patient.
So, John, more specifically, though, how should investors then be looking at specific investment opportunities when they're trying to strategize right now, navigate this fact that the yield is right around 5% levels? Where are you seeing that opportunity within equities?
Well, we'd say the opportunities remain in technology, profitable companies with positive cash flow that are deeply embedded in the lives of both the consumers and business. We also think that you need to be in the industrial sector. Industrials today are not just a lot of machinery, but a lot of technology, whether it's in energy generation, whether it is in aerospace, commercial, and defense, or as it relates to retail establishments and e-commerce. Very important, the element of technology, getting the goods delivered or the services presented to clients.
John, we just got some earnings out from American Express this morning and gives us a little bit more inclination, or at least some more information, I should say, about the inclination for customers to spend by just tapping into credit where they can. But then that also raises the interest of the conversation around delinquencies, or just being able to continue to deploy cash. What would you describe the consumer as right now, especially considering the fact that they have been hearing about recession talk for the better part of a year at this point?
Well, I should add, Brad, the other sector is consumer discretionary. We don't believe in betting against the American consumer. I've been in this business for 40 years, and the American consumer spends like a sailor on leave after a long term of duty during good times. And during tight times, or when liquidity is tight and worse times, they still shop. They just shop at different places for different things, whether it's experiential or stuff. They look for the better pricing, which reintroduces competition for companies involved in that space, which is further support to the Federal Reserve trying to bring the inflation rate down. So when we look at it overall, the upper end consumer tightening the belt a bit, but still by the very virtue of when you look at credit card issuers and you see the results on the crowd that's better heeled, so to speak, better financed in terms of their work or whatever, they tend to keep spending, though they may choose different items. On the other hand, for those in the middle to the lower strata of credit, what has been remarkable is that during the pandemic, on a broad basis, people paid down credit, so are better prepared to increase credit now, and jobs do remain plentiful. The unemployment rate still remains in what would be defined by the Fed's mandate as full employment. And this is, at many months into the Fed funds hike cycle since last March.
John, you mentioned you've been in this business for 40 years, and I got to ask, how would you compare the dynamics and what's happening today within the market moves and what we're seeing more broadly speaking in the economy to other times in the past when you've been a strategist where we have seen some economic uncertainty and obviously then volatility following within the market?
Great question, Sean. The big thing is whenever the Fed is either applying liquidity or taking liquidity out of the system, in our experience, what we find is the Fed's detractors will say the Fed is pushing on a string and is bound to fail. And while the Fed is not infallible, it invariably, because of the nature of its mandate, which is relatively simple, a good economy, so to speak, on a broad basis and relative full employment, it happens to be a complex achievement. So it may make mistakes along the way, but so long as it corrects its mistakes and goes to meet its mandate, gosh, it certainly, in our experience, succeeds. Especially since the Ben Bernanke legacy started in the financial crisis with greater transparency and governance. It doesn't preclude the detractors of the Fed saying it's going to fail. High leverage players are just furious about the Fed's stance right now because it costs them more to place their bets. When they're wrong, it costs them additionally because of the higher margin costs. So they're going to be very much in protest of this. And if you talk to traders, I'm sure they're much less friendly about what the Fed is doing. But we think the end of free money is a good thing in that bond issuers have to pay for the privilege of borrowing money, and bond buyers are getting something in return that, at least to a certain extent, gives them the opportunity to offset risk from inflation to some degree, as well as credit risk, et cetera. And for the equity market, it creates an environment that hopefully will be less speculative, less prone to bubbles, though the speculative interest will always find financing. But at the same time, it creates a market that at least is tested more in terms of its intent. Is it short term or is it intermediate to longer term? It's traders versus Buffett kind of policy. Let's put it that on a broad basis.
John, one factor is going to be largely different between the last Fed meeting and the Fed meeting that takes place in November, and that is the international conflict here. How does that perhaps put even your end of the year target in limbo, considering that that's one of the larger considerations that the market now has to think about, that businesses, executives have to talk about during the earnings calls and figure out exactly where they can navigate this successfully?
Most certainly. Our 4,900 target on the S&P 500 as a year-end target was put in June or July of this year. Prior to that, in last December, we put in a 4,400 target for the S&P 500. That at that time, as I recall, was one of the highest on the street. So in June or July, when our target was, when the markets closed above 4,400, I don't recall exactly when it was, we studied the market, the way the market was performing, the way fundamentals were improving at that time, and came up with a target that suggested about 6 to 7% upside from that point. Last I looked, I think it requires about almost a 14, 15% upside from where we are today. A lot of that has to do with stickier inflation, the market's denial, equity market's denial about the Fed's commitment to bringing inflation down. And then beyond that, of course, is the geopolitical risk, which has worsened as of the last 11 days or so. With the oil price, most certainly brings stickier inflation on that core inflation number of food and energy. Particularly in energy, we look for oil to trade now in a range of anywhere from as low as 74 on better news to as high as probably around that 94 bogey, on WTI. And that's not easy to digest. But we do expect that the likelihood of negotiations will eventually show up, though near term, the price of oil has most certainly risen with good reason.
All right, John Stoltzfus, always great to get your perspective. Chief Investment Strategist at Oppenheimer Asset Management. Thanks so much, John.
Thank you.